Welcome back, and it is time for another Macro Monday, where I get you ready for the week ahead in 5 minutes or less. As always, just a reminder, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage from us on the week ahead, I highly encourage you to subscribe and read the full edition. I will include a link to that in the description of this video. Okay, as always, we are going to start with our chart of the week for this week. As you'll see on the next slide where we go over the data calendar, there's not a lot of consequential data scheduled for release this week. One under the radar data point worth watching in our opinion is actually released today, and that is the Senior Loan Officer Opinion Survey from the Fed. This is also known as SLOOS, so you may have heard it called that before. This quarterly survey of lending standards doesn't usually make headlines, but it is a powerful leading indicator of the overall lending environment. In many ways, right now, lending standards are acting as a form of shadow stimulus. As the chart shows, today's lending environment gives us a strong signal about future credit conditions with a lead time that's about 3 to 4 quarters. The SLOOS series in these charts is in blue, and as you can see, they are inverted, which just means that when more respondents respond to the survey and say they are tightening, 3 to 4 quarters later, we typically see a decrease in actual lending, and then vice versa, of course. So again, as you can see right now, it looks like the red line, so that's the loans and actual leases, still has some upside ahead, but the blue line, the SLOOS series, more respondents have recently been saying that they are tightening their lending standards. So we're going to watch to see if that trend continues. And then, as I promised here, the economic data calendar. It's a quieter week for data, as you can see. We already mentioned that Monday's Senior Loan Officer Opinion Survey is one to watch. And then on Tuesday, we get the July Services PMI figures from both Markit and the ISM, which we will certainly be paying attention to, as always. And then finally, also on Tuesday, the trade balance report takes on more importance than normal. While not traditionally a key input for us, it now offers insight into consumer responses to tariff-induced import costs. Given the ongoing global trade negotiations and early year distortions from tariff front-loading, we'll be watching June's import data for clearer signals. And then finally, to end it off, it seems like this is almost every week at this point, but this is another week where the biggest stuff in our world is not necessarily on our data calendar. So just to recap a little bit about last week, following, I don't want to exaggerate, but I would call it a disastrous jobs report. President Trump fired the head of the Bureau of Labor Statistics. Combine that with the fact that a whopping 33% of the components of CPI right now are being imputed instead of actually being observed directly in the market. It's starting to become a bit more reasonable to question the validity of some of the hard data that we receive moving forward. And so this would sort of force us to rely on some softer data series, and it just increases uncertainty during a time where uncertainty is already heightened. And then finally, a Fed governor announced that they would be stepping down. And this will provide President Trump with the opportunity to put someone who's a bit more dovish into the seat. And as we saw from Chairman Powell during last week's FOMC meeting, he kept rates steady, but there were 2 governors that dissented. All this to say there might be a third voice entering the room soon who will be calling for a cut sooner rather than later. And that's what I'm going to leave you here today. Thank you for watching. I hope you have a great week. Don't forget to subscribe if you learned something new, and I will see you right back here next week for another Macro Monday.